another favorite topic, components of third-party risk management. Hi, everyone. Welcome. Take a seat. All right. So I follow the FFIEC guidance on third-party risk management. Even when you're a non-bank financial institution, I highly recommend this guidance. It may say that it doesn't apply to you. However, it is really sound guidance. It's how I build all my programs. And frankly, if you're working with a regulated party, they're going to expect that your vendor management or third-party risk management has these components to it. So you're going to start with your questionnaires. If you work with a vendor for vendor risk management, a lot of times they're going to have a questionnaire for you. I'm not going to spend a lot of time talking about what's on those questionnaires. But there's another slide with some content, followed by enhanced due diligence, risk assessments. We're going to talk about tools and management systems, reporting, and contracts. So, all right. Who is a third? And I'm including a fourth party. Fourth parties are becoming a pretty hot topic as we're seeing that we need to engage with multiple other parties to either complete a payment chain, such as a payout correspondent, or even just move money around the world, or compliance consultants. So there may be other types of third and fourth parties. These are the most prevalent ones you're going to run into in this particular space. But you've got your vendors. I apologize. I think this microphone is a little wacky. You've got your vendors, your AML KYC vendors. Your security vendors. So if you're doing your SOC 1, SOC 2, Type 2, you've got those types of vendors. Consultants and outsourced teams. You're going to want to make sure you understand what these individuals are doing for you, how these systems function. It is not enough anymore to just say, yeah, we have a consultant for that. Your regulator's not going to stop there. They're going to want to see that you understand what they're doing for you, you're checking in on them, your contracts have appropriate provisions. Partners. This is one from an MSB perspective that can be particularly interesting because I have a lot of MSBs come to me and they say, how am I supposed to perform due diligence on my banking partner? They're a critical partner for me. And I would say, probably don't ask your banking partner for their SOC 2 information. They might not give it to you, but if you're not evaluating your banking partner in some way, understanding their positioning in the industry, do they have consent orders? What's their leadership team's makeup? Do they have the expertise to engage with you? Do they have any other MSBs? You want to understand these things because it can be indicative of either their risk appetite or their ability to continue to service you. Right now, in fintech in particular, we're seeing a lot of small community banks looking to get into the industry because they need access to deposits. Their consumer bases are going to Wells Fargo, they're going to JP Morgan, so they're looking for that access to deposits and access to fees. And they say, I'm going to get into MSBs. They don't understand what these programs are, and they may or may not be talking to their regulators about what the additional enhanced scrutiny is going to be on their program. So they get into situations where they don't know what they're doing, their regulator comes in, their regulator says, you're not doing this right. And you could end up de-risked. It's a cycle that we see over and over again. So you want to make sure that while you're obviously not going to be asking your bank partner for their financials, but you do want to understand who they are, what their position in the industry is. Same thing with your correspondence. You want to understand your correspondence reliability in the space. You want to understand, do your correspondents have correspondence? A lot of times we see nested relationships, third and fourth parties. So really, you need to understand the full chain. Infrastructure and technology, as we become more reliant on some higher technologies, in particular as we're storing value, as we're doing cross-border settlement, our cores and our ledgers are becoming much more important as an immutable source of information. You need to know what dollar amount goes to what person at any particular time. It's not enough to just say, all right, that transaction's gone. It's gone forever. You need to be able to say, this person, they have $5 on this day, they had this many dollars. It has to be much more in-depth than it's been in the past. Relying on a partner's core can be great it can advance your ability to do these kinds of services, but it can also, if you don't understand how they're ledgering, it can present problems to your business. Card processing is another one. Does anyone have card processors that they work with? Is anyone a card processor themselves before I say the next thing? Okay. Card processors are really hard to work with. I have some lovely people that work in card processing, but the Visa and MasterCard schemes are, they're global, and we love those companies, but there's so much data, and there is so much potential for that data to not be captured or not used correctly. So with card processors in particular, there's some amazing data that you can get your hands on from an AML perspective and a KYC perspective if you can get your hands on it. And that's something I'm actually working on for my company, is getting better geolocation, better geofencing data to fight fraud. So you want to make sure that when you're dealing with your card processor, even at the beginning of establishing a relationship with your card processor, ask them what data they can share with you. Ask them how they store that data. Ask them how they maintain that data. It's really, really critical. Payment processing we talked a little bit about. And the other one I want to talk about, suppliers and other physical office vendors. Because I get asked a lot, well, do I have to perform due diligence on the guy who brings me my Diet Coke for the Coke machine? And I tell people, are you leaving social security numbers out on your desk? Are you printing papers in your office? Do you have personal identifying information laying around? Because if that Coke vendor has access to that information, they might trip into that sort of like critical material space without you knowing it. And obviously that's a crazy example. We're not going to perform due diligence on the vending machine guy, but it is an example of how, from a risk perspective, you want to make sure that your procedures kind of put fences around your different vendors so that you're not accidentally exposing yourself to more risk than you would otherwise. So anything to add there, guys? I don't know. Anyone in the room? I know we talk about vendor management a lot. Okay, so on that note, determining the criticality and materiality of your vendors. This is, again, it's really important from a risk-based perspective because it's going to, oh, go ahead. Oh, you got it, Zori? It's freezing in this room. Ooh.
Just a quick question.
Yeah.
At the beginning of the presentation, you mentioned that the prepaid cards are lower risk, if I'm correct.
They can be, depending on how you structure it.
Okay. Because I wondering why you just mentioned that this is lower risk.
So it's lower risk on a spectrum. I deal with mostly deposit accounts with the ability to load infinite number of ACH, receive transactions via wire. Prepaid card, you maybe have your $200 limit. You can only spend it at certain locations. So it's part of that, those four things we talked about in the beginning is depending upon your controls there, they can be much lower risk. That's a good question. But we're also seeing, on the prepaid subject, the blurring of lines between prepaid, and I'm not talking about the reloadable $200 card that you can get at the 7-Eleven. I'm talking about the prepaid access program, which allows MSBs to store value that doesn't actually have to have a card. It can or can't have a card. That program is starting to look a lot like deposit accounts. They're starting to look like checking accounts. And to the consumer, they don't understand the difference. But those are very different regulatory schemes. All right, so from a risk-based approach, you're going to want to focus on your most critical or material vendors. I added the term material because particularly in the bank as a service space where I have spent the last few years of my career, materiality is a definition that our bank partners pass to us that says, there could be a critical vendor like a core processor. We're focused on a material vendor that has access to PII. So there's a small distinction there from a contractual perspective, so I added that on here. But not all third parties or fourth parties require due diligence. If you're performing due diligence on everyone, you're performing due diligence on no one. It's a very long process. It can be kind of a time suck. So you want to make sure that you're dedicating your resources to the right vendors. So some factors to consider that I put on here, these are just things that I think about. Does the third party have access to PII? When we talk about risk management and vendors, one of the best things you can do from a risk management perspective, if they don't have to have access to any of your customers' data, don't let them have access to your customers' data. And there are ways that you can do that. So you can assign a unique identifier to your customers that you can pass and say, hey, this is customer 123. So instead of saying this is Robin Garrison's account, this is 123. And then that vendor can theoretically still perform their services, still do what they need to do, but now you've downgraded them from a critical or material vendor to a regular vendor. You don't have to go through your due diligence process. You don't have to do a risk assessment. Your contracts have a lower standard. So that's one of the best ways that you can mitigate risk with your vendors, is just controlling what access they have to your information. Would failure of the third party result in a critical business failure? If you have a single point of failure in your business that you are not on a regular basis evaluating whether that would take you out, you need to be doing that. So examples of that, your core provider. Banks don't have two cores. Well, maybe some of them do, but most of them do not have two cores. That is a risk that they have to accept, that there is going to be a single point of failure in their business. It's an inherent risk. The residual they're able to get lower because maybe they're working with a core provider that has been doing this for a very long time. Their contracts contain business continuity. They contain disaster recovery. Those are the kinds of things that you want to look for. If you have a single point of failure, just make sure that you understand where that failure is, how you can identify it, and how you can mitigate it. Would a security breach of this vendor present significant risk to the company? Again, if they don't have access to PII, maybe it's not a problem. Is there redundancy? What type of disaster recovery or business continuity? These are just things to consider when you're evaluating the third party. And then how are they regulated? So if your third party is a regulated financial institution, your risk is lower because you've got a regulator coming in, they're getting independent reviews, they're getting looked at. If they're sitting in that weird space, as there are some of these vendors, particularly exempt third-party payment processors, for example, that are not directly regulated, you might want to take a closer look at that because no one else is. So you just want to understand what their regulatory positioning is. Any questions on that? Okay.
The one thing I would add on, you might have mentioned this, is that employee data is PII as well, so don't limit it just to your customer data. Anything related to your human resources systems needs to be evaluated under your third-party due diligence programs, because if that data gets out, you can be in breach of many human resources laws as well as data privacy laws.
That is a very good point. All right, so what do we include in EDD for third parties? You may want to include additional, depending on what you do, what this vendor does, you may want to include additional questions. I'm not going to go into individual questions. If you want to talk about vendor management and what I would ask, I'm happy to do that. Feel free to ask questions. But just from a general high level, you're looking at their business, who their ownership is, their regulatory positioning, their InfoSec and cybersecurity. I am not an InfoSec and cybersecurity expert. You've heard me say this a couple of times, but I'm now starting to dabble. I can read a SOC report, understanding the audit scope of, what is a SOC 1 type 1, what is a SOC 2 type 2, understanding, what SSAE 16 and all of these different technical terms are. If you can go to them and say, hey, are you SOC 2 type 2 and where's your SOC report? Their SOC report's going to be done by a skilled auditor. You can look at it and you can read it. But if you're not able to understand what those standards are and you're having to evaluate their InfoSec yourself, you're going to be in a tough spot. So I recommend that just everyone brush up on your InfoSec. That's what we all want to do today, but understand how that plays into some of the security issues. You're going to look at your contract, like I mentioned, evaluate your contract. Do you have provisions for protecting data? Do you have the BCP that I mentioned? In the event of a termination, who owns that data? Is the data destroyed? Does it come back to you? Obviously, if it's on a server, it's not coming back to you, but these are the things you're going to want to look at. What are the provisions for terminating the contract for non-compliance? And there are a lot of tools out there that will help you do this. A lot of vendors, there's some great vendor questionnaires for free online. I highly recommend just Googling vendor questionnaire, and you will come across a lot of them. I think VenMinder and, oh my gosh, what's the other one? Tandem. They both just publish their questionnaires online for free, and they're great resources. All right, so now we've established we have a material and or critical vendor. We've performed our EDD. Now we're going to do a risk assessment. We're coming back to risk assessments. Again, there are forums available online, but it's going to depend on what the vendor is and what role they play in your institution. So you're going to use the information collected during the enhanced due diligence to complete your risk assessment. Then you're going to accept your risk. Again, like a core provider, there are some vendors that are going to come in high risk. And it is okay to say, yes, this is maybe a high risk vendor for us. Here are the controls we're implementing. Here is what the residual risk is. Or, hey, there's not a lot of options in this space. We're just going to have to accept that the only correspondent to, Djibouti is this one here, and we're just going to have to use it. You have to accept that risk, and it should be an active acceptance. It should not be tacit. It should be, as we discussed in the beginning, your board of directors should be involved. Your company leadership should understand. The team responsible for the vendor, they should understand it's high risk. And then you're going to want to review them annually. So just refresh that information, go out and get it again, refresh your risk assessment. Hopefully it hasn't changed too much. And Zori can take it over, talk about this in practice with correspondence.
Thank you, Robin. And as Robin mentioned, after you reassess your partner, it's because when we're coming close to the microphone, we get the sound break. Yeah, after you reassess your partner, after you accept the risk, you said which is the one to request the complete partner due diligence, or which is the one that I will simple to what I said, and I don't know if you guys are agree with me. At least you need to screen your vendor or your third party at least, because you don't have some screen or any kind of due diligence in your provider. After you assess, you said, okay, I will apply my partner due diligence or my correspondent due diligence. There is 4 steps that I apply, and I highly advise always to everyone to apply. Which is the first one is the first step is information collection. After you send your partner due diligence questionnaire or your correspondent due diligence questionnaire, I imagine that everyone have already your questionnaire, or is anyone that don't have any partner due diligence questionnaire? Everyone have your already established partner due diligence questionnaire? If you don't have, there is many of them in many web resources that you can use and customize according to the products that you will use with your partner. You customize your questionnaire, you send the questionnaire to your partner, and after you send the questionnaire, you receive all of their answers and also all of the documents. When you have your documents, your materials, and your partner answers, take the time to review all of the materials, and you go to the second. After that, you review, you screen, and at the end, after you have all of your answers, you perform a kind of before we can call your on-site visit, but right now with all of the virtual world after the pandemic, you can perform your virtual visit. This is a way to know your partner if you don't have the physical resources in place to perform the face-to-face visit, which is important, but is another world, the one that we live in right now. And at the end, you risk assess your partner. We already talk about risk assessment and include all of the risks in your risk matrix. I will go step by step. With information collection, when you, thank you. Yeah, when you have all of the information for the partner. When I speak about all information, I speak about your questionnaire, your answers, and you determine, okay, with this partner, what kind of services I will have. I will have probably only bank deposit, which is like little safe product, or you will have a cash pickup example. With cash pickup, you need to apply another kind of due diligence. Another kind of due diligence focusing probably in cash pickup policies, and you need to perform your enhanced due diligence. It depends on the product that you will have with your partner. After that, you go review all of the answers from the questionnaire, all of the materials, and determine if you have any missing information. If you miss information, because usually partners, they don't provide the complete package of documents. They provide you certain answers or certain documents, and you need to go back and request the missing information. Or, if you like to discuss with your partner something about the license or about training, any kind of material that you're missing from the first request, you go back with the partner. Another, and I think one of the most important steps in this first part is when you perform your research. Web research is so important. You can have many of these materials from the partner only performing web research. What I talk is about the example when Robin mentioned. When you have any agreement with a huge bank, with Barclays, with any bank that they will not provide you the due diligence materials, what you do, try to document it as much as you can, because if you have any regulator, the most important thing with them is have everything documented. Documented. This is something that I always repeat. And the way that you document, if your partner will not provide you all of the documents, go ahead to their web page. There is annual reports, and you can download many of this information, and at the end request a call with the partner. This is, I don't know if I missed something, Robin, there? Okay. After you have, you review your materials, you have everything with you, all of the materials for the partner, you go ahead and screen them. What I suggest is, you can screen your partner name, the related parties. You also can screen ownership, main managers, your compliance officer. Make sure that you have all information from them and screen them. Usually when you do business with partners, you have some, especially in third world countries, you have many PEPs involved. And when you have PEPs, the important thing there is that you identify the PEPs. Identify and perform some research on the partners, and if you have any kind of match, if you have an internal process to escalate this match and approve the PEP or approve the negative news, will be, at least you can see if it's material negative news or is not material negative news. And if you can, document it and have all of the list how many PEPs you have with your partners. Is in this step, basically, the important thing here is you identify them, identify with your partners if you have PEPs or you have any kind of negative media, and have this documented. There is any questions here? And as the first step, as I mentioned, if you already have all of your documents, or you already have you screen your partner, for sure you will have many questions. You have questions for them about what kind of process they have for training, what kind of process they have if they train their employees, and also if they have a third-party payout network, how they train this third-party payout network. If you have any process to screen this third-party payout network, you need to really know your partner. And the way that you know your partner is, have an open communication with them. Meet your compliance officer. You can go and do your face-to-face, schedule your virtual visit. And if you schedule your first virtual visit, have also like frequent meetings with them. Like they know that you are in this size of compliance, and you know who is your counterparty with your partner. I think open communications also with your business area will help you. That they know that if you're missing, you have any regulator in place. You have the ability to go back with your partner and see if you miss any information. This is really important when you have relationships. It's part of fill out your process, but also have the relationship with your counterparties. And at the end, you perform your risk assessment. As part of your risk assessment, the most important thing I said, is documented everything. Have your checklist, document the analysis that you perform in every single document. If your partner they provide you your license, their license. You can include a couple comments in your checklist or in your risk assessment, about the who is the regulator who provides the license, if the license expires, and if not expire, or if it's expired, you will include any alarm in your Outlook to request a new license for your partner, but documented everything. If they provide you the training materials, document what you see in these training materials. If they miss something, you can have open communication with your partner and suggest that they can improve the training. But the most important part, I think, is document. Also, for this kind of reviews, it's important that you have your approval process. You review your partner as compliance officer or as compliance team. If you have your approval by your compliance team, but if you can elevate and have some kind of leadership approval, implement this process. Like it's a formal process to approve your new partnership, or also approve expansions in countries with services, but have one established process. This is something that also I see that regulator they are asking. And also, as soon as you finish your risk assessment, it's important that you implement your specific risk assessment for partners. And this risk assessment, usually you can create your own risk matrix. All risk matrix, they are so different because for my partners, they are not the same like your partners. Can be the same partner, but I can use different kind of services. And you know that my partners probably can be in one jurisdiction. They can have probably 50 countries, but I use only 2 of them. And if you don't have your partner risk matrix, it's highly recommended to have this risk matrix. And also, according to the risk that you provide to your partner, you see there will be the cycle for your ODD. Your ongoing due diligence process will provide you, the view you need to perform on this partner, probably due diligence every year, or probably you need is a low risk partner and you perform your due diligence every 2 years or every year and a half. It depends on the risk, because not all of the partners, they are the same. This is in general steps, the partner due diligence process. Also, we highlight here some of the inherent risks that we have with correspondence, as Carolyn and Robin been describing. We have product risk, we have geographic risk, we have also the kind of service types. As you see, now before we offer only like bank deposit and cash pickup, right now we see prepaid cards, we see deposit in accounts, we see mobile wallets, and it's many different kind of services that have many different kind of risks. Although not all of the risks, they are the same with all of the services you have with your partners. Also, you have your customer risk. Also, you have what kind of partners you are using, the partner type of business. If I am using a bank, or I am using a currency exchange, or if I am using a retail, this is different kind of risk that you have with your partners. And also, if your partner have any kind of payout network. This is important because at the end is who will pay your transactions. You need to keep an eye in all of your transaction flows and your funding flows, how my data go, who touch my data, if it's only my partner, or if it's any kind of third-party payout network who also will touch my customer data, and I need to apply any kind of due diligence. This is some of the inherent risks with our correspondence. There is any question? If you have any questions, feel free to approach and we can help you. Robin, I think we're going with. Next one, I think is yours.
It's my last slide. You guys don't have to listen to me talk after this. All right. So, managing regulator expectations. This is, we've talked a little bit about this and how critically important it is to, ensure that you're managing your regulator expectations, that you're, documenting the decisions you're making, that you're regularly talking to them about that, what you're doing, and forming that really good relationship with your regulators. So when a regulator comes in for the first time with your risk assessment, you want to make sure that you're prepared to document, show them, defend your risk methodology. We were talking earlier about localized jurisdictions. That's a great example of your regulator's going to come in and they're going to say, why did you risk rate this in a particular way? And a regulator's not going to, they shouldn't come in and critique every single weighting and every single piece of your risk assessment as long as you've got a good methodology for how you're coming about it. But in the case of, the Honduran payments, it's if you're going to do something that is a little bit different than what the regulator is used to seeing, you need to be prepared to defend your methodology, not only with, verbally defend it, but if you've got research, if you've got data, I love data, quantitative risk over analysis over qualitative risk analysis. If you've got, studies and anything to back yourself up, include that with your risk methodology. Outline your process by which you maintain and update your risk assessment. Again, a risk assessment is not a moment in time. It is not static. It is constantly moving and needs to be informed by assumptions, validation of the assumptions, testing of those assumptions. Every time that you're introducing a new product, you should see if there's any impact to your overall risk assessment. So ensuring that your testing and monitoring processes, and whether these are internal, if you have an internal team that is doing your testing and monitoring, make sure that the results of that testing and monitoring, if it shows an efficacy of a control is less than you thought, you need to update your risk assessment. If you've got an outside team, such as someone performing your independent review, and the results of that review are that there's remediation required, you need to make sure that you revisit your risk assessment. Those things all work together. None of the things are separate. It's part of an overall risk management strategy. So determine as a company how frequently you're going to specifically revisit your risk assessment. So you're doing that process of, updating as you're changing and whatnot, but do you have a schedule for actually looking at it, say on an annual or biannual or what have you basis to, say, all right, this is our risk assessment in this particular moment. We're communicating that up the lines of leadership. The way that I do this, I use a compliance committee that meets on a quarterly basis. We review our risk assessment, we review changes to the risk assessment, and we escalate that to the board through that documentary process. You can do this many different ways. I like that process because I've already got it on my calendar, so it's already happening. Then you're going to want to make sure you have appropriate oversight of your risk management and your process. Again, does senior leadership, do they understand your risk assessment? When you're bringing it to them, which I'm hoping that you are, and they're looking at it, and they're seeing, okay, high, lows, mediums, do they actually understand what is on there? And again, that's where you're going to want to engage in that education of your senior leadership, which can be a little bit challenging sometimes because they're your senior leadership. But you want to make sure that they're understanding what goes into that. Does your risk assessment play a part in your overall product feature development? In the beginning, we talked a little bit about how, how we do strategic planning and how we embrace our risk assessments as part of that process. You want to be able to evidence that process. It is not enough for your regulators to say, yeah, we talked to product and they understand the risk. Do you actually evidence that process through a feature proposal or a change request, some sort of official change management process that informs your strategic vision? When your sales team comes to you with a new product and you're saying, all right, where's my channel risk, customer risk, yada, 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 are you storing that document? Are you responding to that document? Is that being presented to your regulators upon request? Can you show that process that you were going through? If you cannot, because you did it on a Zoom call or a Google Hangout, then you're not doing it. You need to document it. You need to tell your regulator what you're doing. And then, again, any relevant committee notes, adopting, discussing the risk assessment. I'm not a fan of committees. They serve a purpose. The purpose of the committee is really not to make decisions. Everyone understands when we go into a committee, we know what the decision is. We're documenting the process by which we come to a decision with the appropriate people in the room, governed by a charter or some other documentation that says these people have the authority to make these decisions. But you're not going in cold to that committee. You're talking to them beforehand, and you're going in and you're saying, all right, today this is our risk assessment. Anyone have any questions? And documenting that process by which you're adopting the risk. Then, again, you've got all this documentation. How are you showing this to your regulator? Make sure that you know where this documentation is. Depending on the size of your company, that can be challenging. But your regulator may not immediately ask for this, but if you're having to defend your risk methodology, you can default back to this documentation to say, look, I understand you don't agree with our decision. This is how we came to this decision. Do we want to change anything about this process? And I guarantee you, if they can see that you've been thoughtful, and they can see that you have been intentional with the risk that you're adopting, that is a very different conversation than if you say, nope, sorry, we're just accepting everything as high risk, and we're in Honduras, and I'm from there, so I'm saying it's low risk. You need to be able to evidence that. Sorry, I'm using your example a lot. It's a good one. But as long as you can evidence that and have a good thought process behind it, that is a very different conversation. Do you guys have anything to add to that? Anyone have any questions about this topic? Or clearly I'm not a fan of committees, so if anybody wants to share committee stories. You guys are quiet after we came back from the break. Yeah.
So the risk methodology, so once you establish a framework and that's reviewed and approved, how often does that need to be reviewed internally and then also reviewed and approved at the board level on a go-forward basis?
So you're talking about the methodology itself, not
Correct.
The actual risk assessment?
Correct.
I would say that honestly depends on your institution and your confidence in your methodology. I know that often I revisit my own methodology and I say, you know what, I need to make tweaks to this, or I need to change this weighting. And so I try on an annual basis to review my methodology, but if I need to, in the meantime, adjust it based on, maybe there was a failure or an assumption I made about the methodology itself, I'll adjust it in that particular time and then use the committee to document it.
And have you seen examiners, regulators expect to see that in the methodology or your policy on how often you would revisit that, or is that just kind of an informal, I'll look at it when I want to look at it?
We have a governing policy that we essentially just say we revisit it every year. But there's no requirement for all of that. It's a risk-based approach to your risk-based approach. It sounds kind of silly, but I mean, annual is kind of where I default on a lot of that stuff.
Cool. Thanks.
Any other questions, thoughts? Okay. I think this is you.
Thank you. I think I'll use this one.
Okay.
Do you want to hold on to this one? Sure. So I want to kind of understand who is in the room. How many of you are executives, CEOs, CFOs?
Got a couple. How many of you are compliance officers? How many of you are on sales side or business development? Finance? Oh gosh, we got a good mix today. Who did I miss? Not you all. Cool. So we are going to get into some of the nitty gritty of building a risk assessment. Yes? Board member. All right. We are going to talk about how to build a risk assessment. How many of you have built a risk assessment from scratch before? Okay. After today, you will be able to say that you have. And this session, I'm going to walk through the components of a risk assessment, specifically how we're going to build it. And then when we come back from lunch, you'll all have handouts there to build your risk assessment. So please, as we go through this, if you have questions, raise your hand because you're going to have to use some of these learnings in the next session. How many of you have heard of the risk assessment track before? Okay, not surprising because I made it up. I was trying to figure out a good way to talk about the risk assessment process. And I thought about a circle, but a circle is not really right because you kind of are moving through the risk assessment process at a different pace in different parts of the year. So to start the risk assessment, you're going to need to analyze your risk. And anything between analysis and evaluating mitigating controls and demonstrating that you've accepted the residual risk, that's going to be the core of the risk assessment piece. That will take you some time, usually between a couple weeks to several months, depending on how big your business is. So you're going to spend some time, usually, as Robin said, on an annual basis, actually focusing on your risk assessment. Then you'll have the rest of the year to implement the controls that you've identified in that risk assessment. So you'll go around the racetrack, and then you'll start back at the beginning of the year, whenever you do your assessment, or whatever risk-based approach you do your assessment. And you'll start again in analyzing what new risks have popped up. And you stay on the track all throughout the year. So we're going to use this as a framework to determine how to go about the process of assessing risk. There are a ton of different risk factors that you can evaluate, but you'll see at the top in green that there are the 4 categories that Robin mentioned earlier. You have your products, your services, your activities. You have your customers, you have geographies, and you have your transaction and delivery channels. The reason why you break these out is because you don't want to just group risk into a single category. I was talking with somebody earlier about how geographical risk is just one component of your risk assessment, but you also have to look at the specific product that you're offering, to whom you're offering that product, and then how it's getting to that customer. We are actually going to go through most of what is on the slide piece by piece. And we're going to do that by applying it through the lens of a crypto exchange. Now you'll see actually during this conference, there's a ton of discussion about crypto. And while a lot of you are remittance companies and you may not even be looking at crypto as part of your business exploration, it is something that's coming up more and more in the industry. And it's a nice lens through which to look to see risk. Because in all honesty, cryptocurrency is a risky business, but there are ways to bring down that risk. So let's start with our products, services, and activities column within our risk assessment. The first thing that I always ask, and Robin referenced this in talking with her product team, is draw out the flow of funds. It's really easy to say, well, we're just gonna, send some money to the Philippines, and that's our, transaction. What more is there to understand in that transaction? Well, actually, there's quite a lot to break down within a transaction from the U.S. to the Philippines. Who are your partners that are going to be sending those funds? Are you going to be partnering with a bank? Are you partnering with other remittance firms? As Zori mentioned, do you have payout partners on the other end? What are all of the stops of a payment all the way through? How does a customer get money to you so that you can pass it along? Are you fronting the money first before the customer deposits it with you, or are they depositing it first and then you are sending it? So when you draw out the flow of funds, that really helps you kind of pinpoint who are all my service providers, what is the order of the flow, what are the different currencies that are involved. And you can do this in Google Docs, in Word, on a piece of paper. It doesn't really matter where or how you do it. It just matters that you do it. So in this particular example, we're going to be taking a crypto exchange. We're going to be doing it very basic. In this exchange example, you have a cryptocurrency exchange that allows its customers to deposit funds. They can use those funds to trade, to basically buy crypto, trade that crypto on the exchange. And then when they want to withdraw that, they can sell their crypto, withdraw it in fiat, and send it back to them. So step 1, customer sends funds to our exchange. Step 2, customer trades on our exchange. And step 3, our exchange sends the crypto to the customer. So that's pretty straightforward. Now we need to understand what are the payment methods that we're actually accepting from our customers. And this is really, again, to help understand what intermediaries are going to be involved here. If I'm accepting fiat, well, I'm pretty sure that's going to have to come from maybe a bank. So I'm going to have an intermediary bank account. If I'm accepting crypto, then I'm going to need to figure out where is that coming from. Is that crypto coming from another crypto exchange? Is it coming from an unhosted wallet? So we need to break down those specific channels and the types of payment methods that are accepted here. In our scenario that we have here, we're just accepting dollars. So our customer is sending us dollars, and we will be sending Bitcoin to the customer. Then we need to identify the third parties that are involved in this transaction. Again, we've already said we're accepting dollars, so I'm going to assume that there's a bank account involved in the middle here. I'm going to actually put that on my diagram so that I know, oh, here's a third party that I'm probably going to need to do a little bit of due diligence on, and I'm going to need to understand how those funds are getting to my bank account. And then we need to pinpoint any applications or systems that we're using in the product. So this is really thinking about, are we dealing with people in non-face-to-face relationships? What we probably are seeing a lot in the industry is I think we talked a couple years ago at the conference around the shift to digital. Obviously, a lot of what we're doing is moving from brick and mortar into the digital space. That means a lot of our previously face-to-face interactions are now shifting over into an online or virtual world. That makes it very difficult sometimes to assess risk because we can't see our customer or interact with them face to face. So now we need to pinpoint, well, how is our customer actually engaging with us? So this is a very confusing slide. I'm going to break it down. The customer is using their computer. They're sending the dollars that we already talked about. And in our situation, they're sending it via ACH within the US. Then the customer is using, again, their computer to log into some platform that we're hosting. And they can, once they have their dollars kind of credited to their account, they can then log into our system and trade that to purchase Bitcoin. Then the customer, again, uses his computer to request our exchange send him the Bitcoin that he just purchased. So this whole thing is happening virtually. We're not seeing the customer. And that is introducing risk into our transaction. So again, at this point, we're not putting any levels of risk here. We're just saying we're laying out the facts so that we can understand what we're going to need to assess. The next step is then to apply some sort of risk assessment to it. So in our particular situation, our flow of funds involves digital assets. I always say for an inherent risk, digital assets is high risk. That is not true for every single digital asset, and you do need to look at the specific digital asset to determine whether it is high risk or not. There are things like USDC, which is a little bit lower because it's issued by a particular consortium. It's very US focused, it's got a lot of regulation associated with it. But for the benefit of the doubt, we're just going to say that digital assets are high risk from an inherent risk level. We can help drive down that risk once we put controls in place. Our flow of funds involves transfers on decentralized ledger technology. So we're transferring Bitcoin to the customer via the Bitcoin blockchain. That is decentralized technology. Again, that's a high-risk technology. We do have third parties involved. So those third parties involve the digital asset exchanges. If we're going to send the Bitcoin, we may send it to the customer's wallet, or we may send it to another digital asset exchange. And we also are receiving funds via banks, so we have third parties involved there. And then our applications and systems, we built a proprietary system platform where our customer can log in from their computer. We are considering that to be high risk at this point because we haven't put any controls to mitigate that risk yet. All right, any questions on products or services risk? Did that all make sense? All right, let's go on to our customers. So the next step is similar to how we developed a flow of funds for the product. Now we're going to develop a profile for our customer. We may not have homogeneity in our customer base. That's probably not going to happen. And so we want to be able to break down which of our customers are individuals, which of them are corporates or other types of entities. In our situation, we actually service both individuals and corporates. We have, from the individual side, we have the main source of funds for our customers on the individual side is their personal income. So they're employed and they get income, and that's what they use to purchase Bitcoin. They are proprietary traders, so they use their own funds, they trade on their own behalf, and their intended product use is they just want to buy Bitcoin for their own purposes. And they're going to be doing $100,000 a month. Okay, now hold on, that's a lot of money for somebody to be bringing in from income. So that's where we start seeing, okay, they're doing proprietary trading. It almost seems like they're doing that as their sole source of income. So we will ask those customers, that's why we're asking, what is the intended use of this product? And we will try to understand, are they using income from some other revenue source, like they have a paycheck, in which case I would not expect them to be doing $100,000 a month, or are they actually trading as their day-to-day income? On the corporate side, we have a market maker. So market makers, if we think about this in the crypto space, they're going to be the ones that are sitting on the other side of a buy or sell trade. They're providing liquidity into the market. So we should expect them to be doing quite a lot of transactions on a day-to-day basis. We understand from our research with our products and our BD teams that our firms that we're going to be doing business with are privately owned. And they are also doing proprietary trading. So they're not taking funds from customers and trading on clients' behalves. And they are going to be purchasing Bitcoin, and their anticipated transaction activity is $1 million per month. So we have obviously some different segments that we're going to have to figure out how to manage the risk for. When we actually apply the risk rating for these different, for the individual and the corporate, we're seeing that the source of funds, employment, ownership and control, and intended product use, we're going to put at moderate for now because there's nothing that has raised any red flags. But for payment methods, obviously they're going to be receiving Bitcoin. They may be trading Bitcoin on the exchange as well. We're going to put that at high. And then anticipated transaction activity, that's a lot of transactions to be doing within a single month. So we're going to put that at high as well. Then moving on to our geographies. So I mentioned in response to a question, taking the Basel Index as one option. Again, this is not the be-all and end-all of geographical risk assessment. There are resources that you can use, and I would encourage you to kind of look at what is good for your specific business. However, the Basel Index in particular is nice if you are a global business, if you have customers in a lot of different jurisdictions, and you need an objective way to risk rate those jurisdictions. The Basel Index covers 5 domains. They talk about the quality of the anti-money laundering and counter-financing of terrorism framework, bribery and corruption through the TRACE Index, financial transparency and standards of a jurisdiction, public transparency and accountability, and legal and political risks. What one gentleman raised to me earlier is that the kind of shortfall of the Basel Index, or what kind of distracts within the Basel Index, is actually some of these other things: financial transparency, public transparency, legal and political risks. Often those can shroud the true kind of risk rating of AML, CFT, bribery and corruption within a jurisdiction. So you may have something that says, oh, this is really high risk because of some other, financial transparency, but for other reasons, AML might be lower risk. So again, that's why I say kind of take it with a grain of salt, or couple it with other sources of information so that it creates a full picture for your business. But for the purposes of this exercise, and the exercise we will do after lunch, we are going to use the Basel Index because it will give you a nice quantitative number that you can then put risk rating to and say it's high, moderate, or low. In the case of using the Basel Index does not give you the risk rating. What it gives you is a risk score. So it'll say, oh, the risk is 5.63. Well, what does 5.63 mean? You will have to determine for your business and this goes back to talking about risk appetite, which thresholds you want to use when you apply any sort of geographical risk rating. If somebody tells you, well, it's 5.63, in my business, that might be a moderate risk. In your business, that might be high risk. So you have to figure out which thresholds you want to use there. For the purposes of this case study, I'm using 0 to 4.99 as low, 5 to 5.99 as moderate, and 6 to 10 as high risk. And what that means is that when I pull, and this is an example of all the places that my exchange could accept customers from, when I pull the risk ratings from the Basel Index for all these different jurisdictions, I can see that the majority of my geographic footprint actually falls in a low risk territory. I do have a somewhat significant percentage in a moderate risk territory, and then I have about a quarter of my footprint is in a high risk territory. So this again helps me to understand, well, where is my footprint and what is the actual map that we need to do to figure out, okay, if I have 45% of my footprint in low risk, does that make my entire program geographical component low risk? Well, probably not, because I have some weighting. Actually, 55% is moderate or high risk. Now, moving on to the last component, we have our transaction and delivery channels. Our customer, we've already talked about in kind of evaluating the product, and actually when you do that initial flow of funds, you'll most likely uncover a lot of the transaction and delivery channels. Our customer is using their computer. We're going to say that's moderate. I wouldn't necessarily call that high risk. There's a lot of online activity. I wouldn't call it low risk because we're not engaging with that person face to face. And absent any sort of KYC onboarding process, that could even be high risk. But I'm going to put it at moderate right now. We are saying that bank transfers are occurring to get the fiat over to us. I'm generally going to put that at low risk. That's a heavily regulated industry. My partner is going to be doing their own screening on the bank side. So that piece is low risk. But we've already said that the trading platform that we've developed is high risk, absent any other controls. And of course, the decentralized technology and the Bitcoin transfer is going to be high risk. So now we've put that all together, and this is our inherent risk rating. Again, thinking about inherent risk rating as, I'll kind of talk about the difference between inherent risk rating and residual risk rating, but if we think about inherent risk rating, I've seen this as an umbrella or a funnel. So you have your kind of inherent risk rating, beating down on the top of the umbrella. Then you have your controls, which is the actual umbrella. And then you have your residual risk, which is the little raindrops that kind of fall down and you may get a little bit wet. We will always have some level of residual risk. It's almost impossible to control all inherent risks. But that's okay. And that's where you can actually go to your board of directors and say, hey, I've done this whole risk assessment. I'm going to recommend all these controls. We think we've calculated that the residual risk is X. Are you comfortable with that level of risk? And then your board of directors can accept or deny that risk. So we've said our products and services are high, as well as our transaction and delivery channels. Our customer base is moderate and our geographies are low. So we have some different components that we can put some controls to. So this is where we are on the track. We've already identified our risks. Now we're going to move on to evaluating our mitigating controls. And your controls will vary. And honestly, you should think about talking with the different teams within your organization to figure out which controls will work for you. Because not all controls work for everybody. And it will really depend on the resourcing that you have available, on the specific activities that you're doing. But in this particular example, this is like my set of controls. Whenever I build procedures for my clients, it is like, this is the list that I will always have a set of procedures for. The first is know your customer due diligence. So in the case of our crypto exchange, they're going to be doing non-face-to-face onboarding. That means they need some sort of onboarding mechanism. They can put that, I think we should put that directly on the platform. Somebody logs into our website, they go through a KYC process. They will need to actually get verified, and there are a lot of tools in the space for virtual verification. The latest thing is liveness checks, so making sure that the person is not just, it's not a picture of somebody holding their passport, but they are actually a real live person. Transaction monitoring. So in our case, we have the fiat coming in, and then we have the Bitcoin going out. We basically have a two-sided transaction that we're going to have to monitor, and we're going to have to put systems in place to monitor both the fiat transaction and the Bitcoin transaction. That duplicates the number of tools we're going to have in place. So now we have to think about, well, what blockchain analytics tools can I use to actually evaluate the crypto? And you have Chainalysis and Elliptic and CipherTrace and all kinds of tools that you could use. You could potentially build your own. There's a lot of data out there to build your own tool. But ultimately, you have to be thinking about how are you going to monitor those transactions. Beyond that, you're probably going to need to do some analysis of the trades that are happening within your ecosystem. Because now you're bringing in money that people can use to trade within the ecosystem. There are a lot of, unfortunately, negative things that can happen within the ecosystem that you have built, including fraud or market manipulation or other things. So you have to think about how you're going to build the right transaction monitoring tools to look for those things. Suspicious activity reporting. So depending on if you're, an MSP or a bank, depending on how you're using this particular crypto within your product, you may have a different way of reporting suspicious activity or different obligations. In any case, if you are going to be using crypto, you should actually figure out a way to draft your narratives that you will report to FinCEN or FCA or whoever you're reporting it to include reference to the blockchain, to include reference to crypto. Regulators and law enforcement are putting a keen eye to crypto right now. There are a lot of cases, and if any of you have been paying attention to the news, there are a lot of very recent cases this past week around crypto, misuse of crypto, misuse of customer funds, and law enforcement is going to be looking for SARs coming from financial institutions that do business with those specific crypto companies. And they have, as you know, ways to look for specific words in a SAR. So they will be taking, crypto or blockchain or Bitcoin or whatever those keywords are, and searching for that in SARS and trying to put together, the keys that they need to. So wherever you can build narratives that are specific to that, you will have a great engagement with your law enforcement community. Unusual activity referrals. This is referring to your own employees being able to refer activity over. Obviously, we talked about the 3 lines of defense. You're going to have to rely very heavily on your front line to refer activity to you, but you have to give them the tools to do that. You can do this in a Google form. You can do it in FormStack is a good tool that I like to use. Or you can even put procedures in place to allow referrals like this to come in through Slack or email or whatever communication device you have. The key is you need to document your procedure. You need to document how you're going to handle that referral, and ultimately how that turns into an alert, into a case, and ultimately into a SAR filing if necessary. Watch list screening. So this is another unique one in our situation, because not only are we going to be screening names, which is standard what you already do, but now we have to look at blockchain analytics and blockchain screening. So OFAC, as of a few years ago, started publishing cryptocurrency addresses. They fully expect companies to screen addresses if they're involved in crypto and ensure that they're not doing business with any cryptocurrency sanctioned addresses. So that now means that we are going to need to build a program to screen addresses and ensure that they don't fall onto a sanctions list. Law enforcement engagement. So as I mentioned, you want to have your SARs be very specific to cryptocurrency where you can, and blockchain. But in general, law enforcement engagement, you'll want to think about how you can educate your own law enforcement community around the product that you're offering. In this case, with a crypto exchange, it's kind of a standard crypto exchange. We're allowing dollars in, we're sending Bitcoin out. There's not too much to have to explain there, but there may be more nuanced cases, or as I start involving more different cryptocurrencies that maybe law enforcement has never heard of before. How am I going to teach my law enforcement community about the activities that we are supporting as an exchange? And I'm sure you all have, good law enforcement relationships, but as you get into more emerging technologies, what can often happen is that there are huge misconceptions in the law enforcement space about what a particular product does. The sooner you can nip that in the bud and actually, inform and educate your law enforcement community about what your company does, the easier it ultimately is when they come and reach out to you with a subpoena, asking you about some Bitcoin address that you've never, or even asking you about crypto that you don't even support on your exchange. You can easily respond to them and say, we don't have any information here. Information sharing. So if we think about, at least in the US, we have our 314B request process. This is going to be pretty standard. I always encourage, if you are based in the US and you're using crypto, definitely be part of 314B. I have made several requests myself and received them, and we're starting to see this grow in the crypto space. And then third-party due diligence. So this is a perfect follow-on to what Robin and Zori were just talking about. Doing third-party due diligence on your counterparties, on your third parties, on your banking partner, on the other exchanges that might be involved in a flow is very important. So those are some of the controls. I, behind the scenes, did an evaluation of all of these controls, and I deemed them to be satisfactory. And therefore, and I'm sorry, there's a typo here. At the bottom, this should say residual risk rating. So again, thinking of our umbrella or our funnel here, we have our inherent risk rating, we have our controls, and then we have our residual risk. The reason why it changes is because we have deemed our controls to be satisfactory. If we had deemed our controls to need improvement, I probably wouldn't change the residual risk, because our controls aren't really doing anything. They need to be improved before we can actually drive down that risk. In this situation, we've said our controls are working, and so Our high risk goes down to moderate, our moderate risk goes down to low, and our low risk stays at low. So now we have evaluated our mitigated controls, we're making our way around the track, and now we need to actually demonstrate the acceptance of our residual risk. This is a common theme in our discussions today. You need to be able to get some sort of written acceptance of residual risk from your board of directors or an equivalent body. It's not enough for a compliance officer just to say, well, this is what is residing in this risk profile and charge ahead. Get it documented really by the ultimate governing body that is going to take responsibility for this. And written acceptance can come in many forms. You can go with the standard board of directors meeting minutes. You can go with a standalone resolution. You could do an acceptance form if you just want to, build something on Word and print it into PDF and send it to the key decision makers or your committee. But just make sure that you get it written down somewhere. And that is us completing the track. What we ultimately will do is then implement all of those controls. This particular course does not talk about the actual implementation of controls. This is really focused on the risk assessment piece. Maybe at a future course we can cover some of the specific controls that you can put in place and how best to implement them. But that completes our loop around the track. And that will put us into the next section for the exercise, which will happen after lunch. It does give us about 15 minutes. If you guys have questions, we can discuss, or you can get like a jump start on the lunch. Any questions?